Okay, now let's look at IFRS 9. For this one, basically, I'll teach you recognition of financial instrument, meaning looking at financial assets, financial liabilities, equity. How do you recognize them? How do you measure them? Majorly, that's what I'm going to focus on in IFRS 9. And also, I will also look at impairment of financial assets. So when we do all of that, then we'll have covered IFRS 9. So let me start with the first one, which is recognition of financial instruments. So when do we recognize financial instruments in our books? What is the recognition criteria for financial instruments? IFRS 9 says that financial instrument is recognized when an entity becomes a party to the contract. Financial instrument is recognized when an entity becomes a party to the contract. Since financial instruments is a contract, abi? So as soon as you're a party, then you recognize it in your books. But the key question becomes, when can you become a party? Abi? Not just, okay, when you become a party. When can you become a party? So an entity becomes a party to a contract. An entity becomes a party to a contract either at the date of agreement or the date of commitment. An entity becomes a party to a contract either at the date of agreement or the date of commitment. So it's just like you entered into a sales agreement with another party. So when can you recognize trade receivables in your books? That is what this one is saying. When can you recognize receivables in your books? It's either the date where either of the party has committed, either somebody has sent money or somebody has sent goods. So there is commitment already. Or probably there is a firm agreement. There's an invoice, not just invoice itself. We don't work with the level of invoice. It has to go a little beyond that. Either at the date of commitment or the date of agreement that nobody can say is not doing again at that point in time. Or probably you want to buy shares. Okay? When can you recognize financial assets in your books that, okay, you have shares? It's the date you have invested. Abi? If you don't invest, you can't recognize it like that. So, date of commitment or date of agreement. So, that is recognition of financial instruments. The next one is derecognition. Derecognition of financial assets. So when we say derecognition, it means removal from the books. So when can you remove a financial asset from the books? IFRS 9 says that financial asset can be derecognized. Financial asset can be derecognized when one, the contractual rights to receive cash has expired. The contractual right to receive cash has what? Expired. Number two, there is a transfer of substantial risk and reward attributable to the ownership of the financial asset. Then you can derecognize it from your books. Either when there is a contractual right to receive cash, or where there is a transfer of substantial risk and reward attributable to the ownership of the financial asset. So whatever financial assets you can have, these are the two derecognition criteria. The first one, your right to receive cash as what? Has expired. And this one is coming from the definition of a financial asset that we said is a contractual right to receive cash. So as soon as that your right to receive cash has expired, you have collected all your money, or the period have elapsed, or you cannot collect any further money, whatever the reason is. As soon as that has happened, then you might derecognize it. But not only that, these two must occur. These two must what? So in addition to this, there must have also be a transfer of substantial risk and reward attributable to the ownership of the financial asset. And when we say substantial risk and reward, it could be you have made an unconditional sale of the financial asset. You sold it. You can sell a financial asset. So when there is an unconditional sale of a financial asset, it means you have transferred the risk and reward. Okay? Also, it could be a conditional sale of the financial asset. Okay? When there is conditional sale, it means there's an option to repurchase. So if that option to repurchase is at fair value, then you have sold. You have transferred risk and reward. But if the option to repurchase is at a fixed value, then you have not transferred risk and reward. You haven't transferred risk and reward. So again, as I was saying, when we say transfer of substantial risk and reward, it also means two things. Is either there is an unconditional sale of that asset, you have sold it, you have transferred it to another party, you have nothing to do with it again. Or there is a conditional sale of that financial asset, meaning you have sold it, but you told the buyer that you might buy it back, or that you will buy it back at fair value. If you are buying it back at fair value, that is fine. That is okay. But when you are buying it back at a fixed price, that you are the one dictating how much you buy it back, for us, we believe you haven't transferred, because you still have control. You haven't transferred that risk and reward. Transferring risk and reward means transfer everything, control. Not you have transferred it, you are not telling them, okay, I'll buy it back at 2 naira. I'll buy it back at 3 naira. No, you haven't transferred. You continue to recognize it in your what? In your books. So that is derecognition of financial assets. So I sent 2 questions to the group. It's not in your handout. I want us to look at it. Before I move to the next one, let's look at those 2 scenarios.